All right, guys, what is up? Good morning. What's shaking, Andrew?
Good morning, Richard.
So, welcome to another episode. We're going to be talking about the three things you must have in place, sorted out, whatever you want to call it, before you buy a house in Canada. Did a survey on the community tab a couple of weeks ago, and this seemed popular. There's a lot of like offside stuff, like how do you buy land, or just general stuff that didn't relate to what we're about to put first here, because I think that these three things are probably the most important that you need to consider before getting into real estate. And when I'm talking about real estate, I'm not talking about acquiring like monopoly boards of land sort of thing. Like we're talking about principal residence, your first home sort of thing. So let's deal with the first item, which is number one is going to be credit score. In your estimation, what sort of work do you think people should do before they even consider buying a house when it comes to credit score? I think the first thing should be understanding what it is, like pulling your credit bureau and seeing where you're at, right?
Yeah, that's exactly what I was going to say. First step is certainly to understand what your credit worthiness looks like. So you're going to have to pull a copy of your credit score. There are some providers here in Canada that give you free access to your credit report. Those websites are Credit Karma and Borrowwell. You can go to their websites and pull a free copy of your credit report. Their scores are different. They calculate them slightly differently because there's two different credit reporting agencies in Canada. One is TransUnion, one is Equifax. Credit Karma uses the TransUnion version and Borrowwell uses the Equifax version. So your credit score may be slightly different from each of those two websites, but they're going to be similar. So if you're in the 800 range, you're not going to be too far off on both of those sites. But that is certainly your first step, is you want to know what kind of credit score you have so you understand what kind of lenders you're going to be able to approach and also what kind of interest rates they're going to be willing to offer you. Because right now, I believe a posted 4 or 5 year mortgage term is as low as 1.7% or 1.75%.
I've seen it posted as low as 1.5, dude.
Yeah,
That's
well,
crazy.
you can't get them lower from the non-traditional lenders. Ideally, like myself personally, I like to stick to the traditional lenders because they're more reputable. And therefore, you're looking at the 1.7, 1.75 range.
Sorry, man. I had to laugh because they still do underhanded stuff. Like, we've talked about that in a prior episode with you, but yeah,
But
okay. We'll call them reputable.
They last longer. Some of these other
Yeah.
lenders that you hear that offer lower rates, you've never heard of. I'm sure that you look at the names and think, I've never heard of this company before. So those are the reasons why I would stick to the big lenders for the slightly increased rate. But checking your credit score is the first step you want to take to understand where you're heading towards home purchasing.
And what do you think a reasonable credit score should be targeted before they even start talking to a bank?
Well,
I mean, let's give people a no-go zone and a go zone. So the no-go zone, what do you think would that be? About 650? I think about 650 is about the standard what most mortgage agents can start to work with when it comes to dealing with institutional lenders, right?
Yeah, if you're looking for a bank to be financing your mortgage with the best possible rate, you're going to want at least 660, probably upwards of 700 if you're looking for a bank. But if you want to go to
700 would be ideal.
Yeah, if you're looking to finance with any lender, there are what are known as B lenders, subprime lenders that would be willing to finance you at a higher rate of interest, so probably in the 3 to 5% range as your APR on the mortgage, and you can easily qualify for a mortgage with them in the 500 to 600 range. It won't be a problem, but you obviously want to target the 700 as your sequence or higher. But if you're around the 660, banks will still be looking and talking to you.
I think that's fair. I don't have anything to add to that. Now, as far as improving credit score, what are your top 3 tips?
Well, improving your credit score, ideally, again, back to traditional lenders and getting the most opportune interest rate on your mortgage. They want debts cleared off your credit report. So if you're looking to finance, I'm just going to throw a name out there. If you're looking to finance your mortgage with Scotiabank, they're going to want to ensure that your debts are cleared off your credit report. So if they're going to finance you for a $200,000 mortgage, you can't be carrying credit cards, lines of credit, loans, anything like that on your credit report. They're going to want them all cleared off. So another thing you're going to want to try to do when you're looking to invest into property as a first-time buyer or as a second or third-time buyer is clear the debts off your credit report. Now, if you've got something manageable, something like $5,000 to $10,000 in credit cards or line of credit, there are ways that you can clear that off quickly. Debt roll-up strategy is one of the areas that you can be looking at. You can Google it. We've done a video about the debt roll-up strategy previously. But if you're looking at carrying higher amounts of debt, 10 plus or 15, 20,000 plus, that's going to be a little bit more complicated. It's not going to be a walk in the park to eliminate that debt. You're going to probably
let's deal with the debt part with point number 2, because that's the second one. But specifically, so having no debt is important to a good credit score. What else is important?
Stable inquiries and stable debt. So if you've got creditors on your report that are continually inquiring for your credit report, that's a bad sign. Creditors are not going to like them seeing multiple inquiries. It might mean that you're shopping around your mortgage. It might mean that you're looking to obtain debt or loans for money, and creditors are not going to like that. So you're going to want to have consistency there, and you're also going to want to have consistency with the items you've already got on your credit report. So let's just assume that you've got a credit card on your report. If you've got that credit card on your report and you've only had that card for say 6 or 9, 12 months, that's not going to be as favorable for you than if you've had that credit card for 5 years or more with that lender. They're going to want to see consistency on your credit report. So that's another thing they want to see is consistency. They want to see the same address, the same amount of lenders, the same amount of debt load, no inquiries, and that you're stable. If they see changes to your report on a regular basis, they're going to be less likely and willing to help.
Let me just sum that up for you in simpler terms, because I think that banks, when it comes to lending money for mortgages, are a lot like women. They want to know that you're in demand and others want you, sort of thing, and that you're not needy. You're not like the typical simp that throws all this attention and tries to get stuff and gets shot down all the time. So if you get a lot of inquiries on your credit report, let's say you're looking for a vehicle, for example, and you've got a inquiry from Honda, Hyundai, Toyota, Kia, and they're all within about a 3-week period because you're shopping for a vehicle and they've all shot you down. And then there's an inquiry from the loan arranger, credit card, we approve everybody, guys. And they're the ones that you're financing with. They're going to know that not a lot of high quality type of lenders want anything to do with you, and that's going to bring your credit score down. So you want to demonstrate that you've got the credit worthiness. Having a very high score. A very high score is relative. I mean, 700 is not a very high score. It's high enough so that you can get the best rates. So that's what you want to aim for. So get rid of credit card debt, balances that you owe. Make sure that if you do have anything on there outstanding, that you're paying it off in full every single month and that you're not carrying a balance. And the last thing I would say, beyond not making a ton of inquiries back to back to back, is make sure you never charge more than 50% of your limit. So if the limit on your credit card's $5,000, never charge more than $2,500 a month, because when you start going beyond that, you're starting to approach the limit, which creates a brand new risk profile, which starts to lower your credit score. There's a whole algorithm that's behind it, which I don't have time to explain. But that is the first point when it comes to dealing with your credit score. Let's go to point number 2, which is dealing with the credit card debt, because that eats up your disposable income. What they're looking at is they're basically saying, okay, Andrew makes, let's say he makes $5,000 per month, and he's got obligations to pay $2,500 a month to different credit items. It might be for car loan, might be for a couple of credit card balances that he's been carrying that he's not paying off. He's not making $5,000 a month. The way the bank's going to look at it when it comes to approving you for mortgages, how much disposable income does this guy have that he can apply to his mortgage payments? And if it's eaten up by other loan payments, then your true income is really only $2,500. And then they've got to factor in housing expenses, to pay for obviously the mortgage, heating, the utilities of the house and all that sort of stuff. So it's really, really important that credit card debt gets dealt with. Over to you, Andrew, because you're the expert over in the Office of Total Debt Freedom. So what's the best ways for people to eliminate the credit card debt? And this is where I do the shameless plug and drop the links here for the company below. So,
well, best way is to hire us, obviously. But
obviously,
in reality, you got to know your situation. You got to know your circumstances. As much as I would like to speak about the company and what we do, there's various different areas that you can look at. But what you need to determine is how much debt you've got, how much money you are paying monthly towards that debt, how much money you can actually afford to send towards the debt elimination. And then you can determine what areas and what options you've got available to you. As I mentioned earlier, if you've got a smaller debt load, and I mean no disrespect, but to us, a lot of individuals are inquiring with debts between $2,000 and $7,000, and they're looking to eliminate their debt, which is a great thing. But those types of debt loads don't qualify debt for debt systems. Credit counselors won't take them on. Bankruptcy trustees won't be able to help. We're not able to help out. So for smaller debt loads like that, the suggestion always will be is a debt roll-up strategy. You're using your disposable income to allocate towards your creditors to eliminate them one by one. Now that process might take you a year or two, but at least you're going to preserve your credit rating, and you're also going to be able to eliminate that debt quicker than if you were just remitting your monthly minimum payments and then allocating your cash flow surplus for entertainment purposes. So you're going to want to obviously prioritize eliminating the debt. Now, if you are carrying a larger debt load, let's just assume that the debt load is $20,000. That's going to take you a little bit longer to eliminate. So don't expect that you're going to be able to eliminate a $20,000 debt load overnight, unless you're sitting on money in your bank account. And if you're sitting on money in your bank account, you shouldn't be carrying the debt to begin with. So if you're carrying that kind of debt, you're going to want to inquire with us. We can give you some options. We can determine what your situation looks like. The consultation is free, and we'll be able to put you into a program that varies between 12 months, which is 1 year, obviously, and upwards of 5 years to eliminate that debt. So you really need to determine what kind of debts you're looking at. So again, the credit report will help you out determine what debts you have to eliminate. And then you need to sit down and determine what kind of monthly cash flow you could throw towards that debt to eliminate it. Because if you're unable to extinguish that debt anytime soon, then it might not be a good idea to be looking for property to begin with.
I have nothing to add to that. Beyond your options, basically, if you've got credit card debt, are bankruptcy consumer proposal, which is the same thing. I would say that would be something to consider if you have absolutely no assets and a ton of debt, like loads of it, like $100,000, and you have no assets whatsoever and you've got nothing to lose. That's something worthwhile. Debt consolidation loans don't work. We've talked about this before. You can't borrow your way out of debt. Search the channel for more on that. Nonprofit credit counseling is basically a joke. It's a kinder, friendlier collection agency for the banks. It doesn't do anything to improve your credit score, and it takes far too long. Search the channel for information on that. What do we miss? Well, there's our program, and there's our program, obviously, which is down below. So if you have over $15,000 worth of credit card debt, and what you're doing is not paying it off, so you're carrying a balance, you're not seeing the balances come down. Go to the website, totaldebtfreedom.ca, fill out the form. Don't just fill out the form, but after you fill it out, schedule in a call to talk to a representative so you can get the consult. If the program's a good fit for you, they'll build it out. You can get started pretty quickly. If it's not a good fit, then they'll send you off in a better direction that will solve your problem in a way that's suitable to your goals. Let's move on to raising a down payment, because here in Canada, CMHC, which is a housing insurance company, basically forces you to pay, I guess, insurance premiums on your mortgage in the case of default. If you're not putting down, what was he meant? Was it 20 or 25%?
20%.
20%. So if you're not putting down at least 20% on the value of the house, you're going to have to use CMHC insurance. And how much does that raise the payments by? I'm
not too sure, to be honest with you. I don't think it's substantial, but it's still additional monies that you're paying out for.
Let me go look it up while you talk about it. So go ahead. The floor is yours.
So CHMC is basically an insurance provider. It's there's two insurance providers for mortgages. I think the other one is Genworth. Genworth is a private-owned company, and CHMC is actually a state-owned or federally owned insurance provider for your mortgages. If you're looking to buy a property, you essentially want 20% down. In fact, you want more ideally. You want to carry less debt if you can, but the threshold to look for is a 20% down payment. So on a $100,000 house, strive to have $20,000 as your down payment. That would mean your mortgage is $80,000, and that also means you don't have to pay the insurance premiums through CHMC to protect you in the event of default, or to protect the lender in case of default. Looks like Richard's got something going up on his screen there.
Yeah, so it looks like if your loan to value is higher than 75%, you need to involve CMHC, which is Canadian Mortgage and Housing Corporation, which is basically an insurance policy in case you default on it. So you have to have it by law on mortgages where you don't put sufficient money down. If you go and put 30% down or more or whatever, or let's call it 25% down or more, because it looks like it's 75% where the line in the sand starts, you don't have to deal with this. But at up into and including 75%, you're talking 1.7%. And then it goes all the way up to 3.10%. So the less money you put down on your purchase, the higher your premiums are going to be on the total loan. So while 3.1% may not seem a lot, that's basically $3,100 on every $100,000 that you borrow. That can add up. So ideally, before you buy a house, my recommendation always is put a good chunk of money down. And a good chunk of money in this case, something reasonable looks like to be about 25% or more. And that'll keep your cost of carrying the mortgage reasonable. It also gives you the option, if you want to borrow against any equity in the house in the future, you want to do a renovation of the basement, put a pool in the backyard, whatever, it gives you access to some money to borrow against the equity you've built in the house. Does that make sense?
Yeah, I agree.
Okay.
The numbers that I was looking at, actually, though, Richard, from Google is 20% down, and the article was published in January of 2021. So I'm not sure if they might have updated their requirements for the down payment.
This one doesn't have a date on it. It's just the first result on Google, so I'm not sure.
So they might have updated that, but I remember it used to be 25%, but the most recent article that I've just found says 20%. They might have changed that. Obviously, I can't confirm or nor deny. I don't work with CMC. But you definitely want to strive for a down payment of at least 20%, ideally more if you can stretch your budget to get more, if you're able to source funds from relatives, if they're able to give you a gift for the purchase of the property. But essentially, that is something that you want to try to avoid is the CHMC or Genworth insurance coverage on the property. It's going to increase your premiums. That's money better spent elsewhere in your budget. So in essence, you want to build that down payment. Now, in order to build a down payment, it's also important to note that you're probably not going to be able to carry debt at the same time. If you're carrying debt, again, let's just use the example of $20,000 in debt, and you're remitting payments of $400 per month towards those credit card debts or that unsecured debt to the creditors, it's unlikely you're going to be able to start building up to a 20 or 25% down payment at the same time when you're carrying that debt, which is why we've just explained that what you want to do is check your credit rating, know what you look like there. But also the second step is eliminate any of your debt. Because if you eliminate your debt, you're going to get better lenders on board, but at the same time, you can start building for your down payment. So, it's a catch-22. You want to eliminate your debt, but you want to build your down payment. You got to ensure that you've got enough money in your budget to be able to do that. You need to be able to budget for the savings to get your down payment, and you also want to have enough money in your budget to eliminate any debt you've got that you have outstanding.
All right. So I think with that being said, we can probably wrap it up. If you guys have a topic that you want to suggest that we cover in a future cast, comment below. It seems pretty straightforward. If you're just pulling into the cast, live as we're through it, scroll back to the very beginning. Again, the three that we covered was credit score, dealing with debt, and then raising a down payment. Get yourself familiar with those things before you go out shopping for a house. Get some clarity on it. Make sure you've dealt with them properly. If you have credit card debt, and again, what you're doing is not working, meaning you're not paying it down, you just see the balances getting kicked forward to the next month. Maybe there's more month at the end of the money for you, sort of thing. We get it. Bad stuff happens to good people still. So if it's over $15,000, you can visit totaldebtfreedom.ca. Again, it's here. I'll also put the link below, pinned in the top comment, and you get a free quote. Again, when you fill out the form to get the quote, don't just fill out the form and just leave it. Schedule in a consult. So you have to schedule in the actual call. If it's a good fit, they'll break down the program and issue you a quote. If it's not, they'll send you off in a better direction. Maybe another company can offer a better solution than what TDF can. We'll see you guys next Saturday morning at 9 a.m. Thanks, Andrew.
Enjoy your long weekend, everybody.